Hi, and welcome back again to Tim Bigham's Options and Volatility newsletter. Be taking a look today at my most recent Schwab Network appearance from Wednesday this week with a call calendar spread idea pre-earnings on Salesforce. So let's jump in and take a look. Here's the actual recommendation. Salesforce reports after the close on Wednesday, right? Shares held the critical support level at 225 after getting deeply oversold. So the technicals looking good, right? Valuations at trough levels as well. So the fundamentals looking good. Salesforce past four earnings has beaten earnings pretty soundly, yet the stock has been almost cut in half in that time frame. The options are implying about a 7% earnings based move. So I think it sets up ideally for a call calendar spread. So buying to open the traditional December 19th 250 call. The stock was about 235 at the time, right? Selling to open the 250 call that expires this Friday, the earnings week options, right? Paying $1.60 net debit, buying under a 60 implied volatility on that December 19th option, right? And selling over 110 IV on this week's call. So massive term structure violation. Normally you don't see this kind of 2-to-1 ratio, right? The 250 strike price, right? That's the one we chose. It's right at the upper expected move boundary based on that kind of 7% move, right? And then we also have next week's, the 12/12 expiration calls to chop wood, as I term it, to further hedge if need be. So here was the actual trade on the close. You can see it closed right at that one kind of 60 level, right? Able to sell about 120 IV, right? 119.99, buy under a 55 IV. So more than 2-to-1 as far as what we're buying at 55, selling at 120. That term structure volatility, a massive edge to say the least. We talked about the technicals. Here is CRM. You can see it held that kind of 225 level on more than one occasion. So that was major support. Had gotten deeply oversold on the technicals at that point, but now starting to strengthen. We love to see that. We don't want to jump in front of the train, right? But once the train slows down, we don't have a problem going along for the ride, right? You can see it was also trading at a big discount to that 20-day moving average. And as we talked about, implied volatility certainly at an extreme there as well. Valuations also at trough multiples. Here's the price to sales chart going back for basically a little over 2 years, right? You can see price to sales had dipped to the lowest level by far over that time frame, starting to strengthen a little with the stock heading higher, but still at a trough multiple. PE, the exact same thing, right? Over that same time frame, PE had dropped sharply, right? So valuations certainly getting very, very, I think reasonable is a good term for that. Back here, it shows you Salesforce, how everyone was kind of overpaying for that as well. And then taking a look at like Snow versus Salesforce, right, which both came out with earnings. Snow was getting hit after market, right, as you can see, right, even though their earnings were a little bit better on the surface than Salesforce, but you can see how price to sales went from 14 times to over 21 times, right, over the past year or so, whereas Salesforce price to sales went from just over 7 to just under 6. So certainly valuations getting better on Salesforce, more expensive on Snowflake, right? Price to book, same thing, slightly over 4, now under 4. You can see here with Snowflake, price to book under 10 basically a year and a half ago, roughly, right? Now over 37. So that's why even though Snowflake earnings were good, right, the stock got hit. They were good, not good enough. Similar to those AI stocks that came out with very good earnings, right, but headed lower. So that's how we look to go about taking advantage of what we look to be a fusion approach to trading, right, where we look at fundamentals, technicals, and especially implied volatility analysis. Make sure you position size in a defined risk way, which certainly the call calendar spread trade is. And as always, trading is about probability, not certainty. Take care.